ETF stands for Exchange Traded Fund. In simple words, it is a mix of investments in different assets such as stocks, commodities, and bonds, which can be traded like a common stock. Therefore, if you would like to invest your capital, but you have no clue which company you should invest in and are looking for stable long-term growth, an ETF would be perfect. Many people confuse ETFs with mutual funds. However, there are some key differences. Firstly, an exchange-traded fund is usually passively managed based on an index, whereas a mutual fund is actively managed by a fund manager. ETFs have no minimums, and an investor only needs to pay the price of an ETF at a certain point in time. So if, for example, the ABC ETF is priced at $20 per share, then the minimum requirement is just $20. However, a mutual fund has a higher initial deposit in most cases, which is usually around $3,000 or more. Exemptions may apply. ETFs usually have lower expense ratios, which are around 0.44% per year, whereas mutual funds range between 0.5 and 2% per year. A mutual fund is priced at the end of each trading day based on the net asset value, whereas an exchange-traded fund is priced exactly like a stock. Therefore, if you would like to trade your ETF instantly, you can do so. Finally, one of the most important differences is that anyone can invest in an ETF. As we said in our previous video, there are many brokers you can choose from, and therefore, if you have an account with one of them, you can easily trade ETFs. However, with mutual funds, things are not so simple. In most cases, mutual funds require a US address in order to invest in a US mutual fund. However, some exemptions may apply. Now, let us take a real-life example to show you the return if you would have invested in a certain ETF. Sam has $10,000 in the bank and he would like to invest it for the long term. Let us say that he is willing to hold his position for 20 years. However, Sam has no knowledge regarding specific stocks. Therefore, he trusts well-known firms such as Vanguard to grow his portfolio. Vanguard ABC ETF follows the S&P 500 and also offers a 3% annual dividend. Therefore, let us take the average return of the S&P 500, which is 12.25% per year for the past 20 years. The annual expense ratio is 0.44%. If we do the math, Sam's portfolio is worth $181,791.70 after 20 years. A return of 1,718% was not bad for a passive investment within 20 years. If you want to learn how to invest your capital or create a successful business plan, access the Student Investor online course and business plan example using the links below. And do not forget to join our community through the Student Investor website and subscribe to our channel.